minimize. Oh, minimize
There you go.
taxes.
All right. Well, welcome everyone. My name is Gabrielle. I work in marketing for Madrona Financial and CPAs. We're so excited to have you all here for the final webinar in the Business Owners Playbook series. Welcome back to those that have joined us in this journey so far, and hello to the newcomers. So today we'll be discussing the tax planning and reinvestment opportunities. If you have any questions, please submit them in the Q&A tab, and the speakers will go over them at the very end. So let's get started.
All right, thank you, Gabrielle. So, yeah, this is the last of the four. John and I were just chatting. We're going to miss doing these. They're kind of fun to do. I think they're certainly very informative. And if you've missed the other three, make sure that you get those recordings. Those are really more of a deeper dive into the topic. Today is more kind of after the sale or planning for some things related to the sale, not the actual sale of the business and getting it ready for that. That was covered in the first three. So definitely encourage you to look at those. So today we'll be talking about tax strategies, and I'll be kind of popcorning around different topics related to that. I certainly couldn't do a tax planning and investment planning analysis in 30 minutes. It's not possible. So I'll pick some of the highlight topics that often get asked in these situations where you have a business, you have a big legacy issue, you have big cash flow, big tax, those kinds of things. So we want to talk about some of the opportunities available on that. Here's our two speakers today. If you've been watching the other segments of this four-part series, you know us well already. A little background on me, if you don't know, CPA for 40 years, been a partner here at the CPA firm for 33, and have started Madrona Financial 25 years ago. And a lot of you hear me on the radio. I threw in this slide this time. It's not just the Brian show here. There's a lot of us here. We started many years ago with Bob Bauer. It was Bob's firm, and then I came to work for Bob, and it was the two of us. Became a partner shortly thereafter. Since then, we acquired a firm in Bellevue, Ross McIver managed, and it's still working there. And added some partners along the way: Christy Henderson, Joel Maher, and Richard Himmer, and a lot of other people. About half of these folks are on the accounting side, and about half are on the investment side, and a number of us do both. So I just wanted to show you that we were not a one-man show here. John, go ahead and tell us something about Chinook Advisors, Capital
Yeah,
Advisors.
Chinook's a boutique investment banking firm and M&A advisory firm. So all of our clients are business owners that own a business, and they want to plan for a future transition of that business. So we get in early, we do valuation work, we help get businesses ready, we represent business owners in transactions. We have a team as well, 7 professionals. We serve the Pacific Northwest, so our clients are generally in Washington, Oregon, Idaho. We have a client in Alaska right now, and we've been doing this for a very long time. And we have a phenomenal track record of working with business owners.
I think some of the things that's jumped out at me about your firm is just the degree of understanding and depth of knowledge and all this stuff. That's another way of saying we're old, John, I think. But and I also jumped out at me all the different industries that you serve. There's businesses. There's so many different businesses out there that are in businesses you don't even think about. Do you have any really interesting ones that maybe somebody wouldn't even have thought existed?
Yeah. So we represented Gem Shavings. He had a business where he collected wood shavings from the sawmills, processed them, bagged them, and sold them to horse owners as horse bedding. And he built the largest horse bedding business on the West Coast, and we represented them in a sale to one of his competitors. So if you asked me, whatever, 5, 10 years ago, if I was going to be selling horse bedding, I I wouldn't have guessed that one, but yes, we represented that company.
Horse betting, awesome. I knew you'd have one right at the top of your head. You've sold over 100 businesses here, so probably seen a lot of different interesting stuff. The same thing with us as a CPA, you know, for so many years. The types of businesses and interesting stuff. I grew up basically farming and all that, but it just opened a world of wow, they actually somebody. Yeah, I guess so. Somebody needs to do that. And it can be a business. And sometimes those are some of the best paying businesses because, as I always tell people, if you have a skill set or a product that is unique and hard to obtain or don't have any competition, that can be fairly lucrative. You want barriers to entry. You want to be in businesses that not everybody's doing. You know, I'm sure you haven't sold a whole lot of espresso stands or businesses you see everywhere. You probably sell most of your businesses, I imagine, were rather unique. Would that be the case?
That's correct. Yeah. And I would say we specialize in boring businesses. So
Mm-hmm.
steady growth, steady profitability, businesses we can understand. So if it's someone has an idea and they're trying to convince me that it's worth $100 million, that's probably not an ideal client. But yeah, just mostly just very traditional businesses, manufacturing, distribution, business services. Is most of our clients.
Okay, great. Well, thank you for that. I'll kind of jump into the tax topic here. A lot of people come to me and they say, Brian, how do I get out of taxes? I'm selling my business or I'm selling my real estate or whatever. Or I just want your CPA, get me out of taxes. I'm like, well, that's not really tax planning. Most of my clients can't get out of taxes, regardless of what the press says about that. Tax planning to me is a multi-year, multi-decade process where we want to pay the least amount of tax over a long period of time. And then maybe that period of time is the rest of your life and beyond even. And so there are a ton of strategies that can help us do that. One way to visualize tax planning, I think, is just this screen here. There are many different tax rates. If you make a lot of money or have big transactions, you're paying some amount into each one of these buckets on up and I didn't even put in all the capital gains buckets. That's a whole nother list of buckets. That's 0 to 15, the 18.6, there's 20, 23.6, and then there's potentially state tax on top of that if you're in Oregon or a taxable state. So there's a lot of work that goes into tax planning. Again, it's not a single year thing. It's a multi-year process. So when we do financial plans for people and planning for a sale of a business or sale of real estate, we want to look into how that fits together in a longer term plan and talk about topics that may help them from beyond. John, maybe you could interject when you work with business owners historically, where does the tax topic come up generally in your process?
Well, I'll tell you, it's like a topic that is avoided like the plague. And it really is surprising because I think business owners get so focused on the transaction, right? Okay, I'm gonna, sell my business for 20 million and, net of, transaction fees and debt, I'm gonna walk away with 18 million. And I think they just kind of surrender that, okay, that's it. Day one, I'm going to pay tax on my $18 million and there's really nothing I can do about it. And, I do everything I can to say, hey, we could do some tax planning here so that you could spread out that tax. And I really like this graph because, it helps to visualize, hey, if we could defer some tax, and if you're 60 years old and, it's hard to ask someone, predict when they're going to die. But, if you're 60, let's say you got 30 years of life left in you till you're 90, you're going to, over time, in future years, you have less income and you're going to be at a lower tax bracket. So actually there is ways that we can reduce the tax, but you can't do that after the sale, right? You really need to be doing that tax planning before the sale so that, when you receive the funds, there's different things. And that's what I'm excited to unpack here in the next, 20, 30 minutes or so with you, Brian.
Great, great. So one of the things, we have those brackets, but I don't encourage people to go out and execute this strategy. It means that somebody has passed away. But one thing that people don't understand very often when I talk to them is a concept of the step up in basis. And in the state of Washington, I'll start with that. We're a community property state and one of 9. And there's 41 common law states. We get a double step up in basis. So what that means is, let's say you bought Microsoft way back when, or whatever, or even your business, you started it in your garage, doesn't have any cost basis, and then you sell it for $1 million. And so you're going to pay tax on $1 million gain. Well, if you pass away with that asset in your estate, then the cost basis on the date of death moves from whatever you paid no longer matters. It's what is it worth on the date of death. So if it's $1 million and you sell it for $1 million, there's no gain. So a lot of people don't understand that. In the state of Washington, it's a full step up. It's not just a half step up like it would be in Oregon and other common law states. This does not apply to your IRA type funds, to annuities and installment sales. So installment sales are often part of a business sale. So understand though, if you have an installment contract, you're deferring the gain. Someone is going to pay tax on that someday, whether it's you during your lifetime or after you pass. Your heirs would pay the tax on that. But for the rest of our assets, there's a potential for a step up in basis. And this is, for heirs or for your spouse, certainly if you're the first to pass between the two of you. Important legacy planning concept. So very often we'll be looking at situations as people age and we're doing financial planning for them. If we're selling assets to do other things with that money, we're probably not touching some of the high gain assets. We bifurcate those out of the equation first because we just don't want to volunteer that tax because it may be possible to completely eliminate it. I don't know, John, if you have any comments from people on this topic.
I look at we worked with a business owner. So she was, say in her 70s. She had inherited the business from her parents. And she had 3 children and a number of grandchildren, and the wealth that was going to be generated from the sale was meaningful. So say in the $20 to $30 million range. So so she really recognized that there was no way she could actually spend that much money. And so she did set up some trusts, for her family members. And again, in the last talk, we talked about valuation methods, and we were able to move some of the equity into those trusts so that when the sale happened, those trusts benefited from the sale proceeds. So here with this concept of step up in basis, it's really possible to, if you were just saying, hey, I'd like to give money to my kids and grandkids, if you just do it on an after-tax basis, you're really paying the maximum tax, where with some tax planning, you could actually, even almost avoid the tax.
Yeah, and as a part of the tax planning, there's 2 big areas. We'll talk more about them today. It's the income tax and the estate tax. So we can be looking at both. So we want to be aware of each. As you may know that currently, if you pass away, you've got about a $12 million federal exemption. That is going away though. That's dropping way down here in 2026. The Trump tax cuts are going to be repealed at that time automatically. I remember when the exemption was only 600,000. That exemption could change. I've seen it, all over the place. And so the state of Washington exemption is 2.2 million. And so if you pass away, let's say with $5 million, well, you got almost $3 million taxable.
And
to the
again,
state
is
of
this for
Washington.
individuals or married?
This is for individuals. And
Right.
the way to double this amount, now, if you're married and you don't have an updated will or revocable living trust, this is what it's going to be. It's very easy to double these amounts. And that's what's called the credit shelter trust here, or AB trust, or exemption credit trust, whatever you want to call it. It's where when the first of the couple passes away, there might be an amount put into a trust, and it qualifies for the exemption. And then when the second passes away, they get their own exemption again, so they get to double it essentially. If you don't have that, and husband or wife passes away and leaves her assets to the surviving spouse, there's only going to be one exemption. So that's a pretty easy fix for, at least in the state of Washington, 2.2 million at say 20%, you know, that's over $400,000 of tax savings just by putting a paragraph in your will saying, if I pass away first, let's put enough for the Washington exemption anyway into a credit shelter trust. Just save 400 grand for your spouse and your heirs.
And tell me the date in 2026. Do you know what date it is exactly?
January 1st.
Oh, it's January 1st. So it's actually 2025.
Yeah, it's actually, yeah, we got a year and a half.
So we could have a clock here, and we could say that this exemption is going to change in 18 months.
Yeah.
And what I can tell you is that every trust and estate planning attorney I talk to, every CPA, every wealth manager, you know, they're predicting that everybody's going to wait to the last minute to get all this done. And there's not going to be enough labor in the market to get everybody set up. So, you know, this is a real thing, and it's going to happen in 18 months. I would say in 12 months, forget it. You know, it's just going to be, you know, people are just going to, there's not enough hours in the day to do it. So you really have a 12-month window to get on top of this, and that's, you know, take it or leave it, but that's what's going to happen.
That's a really good point. That's like when somebody comes to our CPA firm April 1st and says, will you do our tax return? Well, how many ways can I say, heck no? I mean, everybody's too busy. We got, you know, we're going to take care of our clients. So there's just no way we can fit somebody in. So that's a very good point as far as the planning here. But there's a lot around this, because this could be a huge number. You know, the estate tax rate is, you know, 40% federally. And so you think about what that could do to generational money. There are gifting strategies around that, multi-generational strategies that could make we'll be talking about a life insurance strategy in a little bit here, but a big area that sometimes we don't like to think about, because, you know, somebody has to die for estate planning. And so in addition to income tax, we certainly have that topic. One way around that, I had a client who was selling, in this case, not a business, well, it kind of sort of is a rental apartment business, and did a 1031 exchange with us into passive real estate. And he called me up one day. He said, Brian, I got a problem. I said, well, what's that? And he said, well, my net income used to be X, and now it's 2X. What am I supposed to do with the additional money? It was a lot. And so we came up with a strategy where we were able to buy a life insurance policy outside of his estate. We put it in something called an irrevocable life insurance trust. So he paid the policy through gifting to his children. And basically, the gifts would go into the trust would buy the policy. And we actually did something called premium finance universal life. So we had a bank make the big policy payments, and that money that went into the trust just covered the interest on the loan. So we were able to highly leverage that policy and create a massive amount of liquidity that when they die, it's going to pay to the trust. There's no income tax on life insurance, and there's no estate tax because it was outside of their estate. And so it would provide the liquidity to pay the estate tax that was going to be owed on their estate. So that's one way to use life insurance as an asset class with estate planning. Another way is some people, they're like, I'm going to be in a high bracket. I'm worried that the government, with all the money they're borrowing, are going to jack up tax rates. And I believe that they will someday. And so is there any way to have income in my retirement that's tax-free? Yes, there is. You do it through life insurance. So you can buy a universal life policy if your health, if you qualify, with your physical and all of that. And if you give it enough years to build up the cash value, you can literally borrow against your own future death proceeds. And when you borrow against your cash value in your life insurance policy, that's not a taxable event. So you can borrow throughout your many retirement years. When you pass away, the life insurance pays back the loan and the accrued interest, and there's a little extra left over for your heirs. And so that's a way to create almost like a tax-free pension. So sometimes we use that in tax planning,
Brian,
legacy planning.
So you just kind of went through the life insurance as an asset you can borrow against. You talked about life insurance in a trust. So this is all part of a kind of a comprehensive tax plan for a business owner. So what does that financial planning process look like? I mean, how long does it take? Just paint a picture, like people. I mean, I think what I'm frustrated is that there are solutions to problems, but people just are too busy to slow down to really, think through the problems and understand the solutions to, really avoid, maximizing their tax liabilities in these transactions. So what would the planning process look like?
Yeah, at our firm, we go through a integrated financial plan. It's pretty detailed. The questionnaires and that we ask for don't take the client that long. We get copies of tax returns, wills or living trusts, and so forth. So we get a good handle on what's going on, what you have. We don't know the questions to ask. The reason that it doesn't get done very much in the real world is that there aren't a lot of financial advisors that are licensed in tax planning or estate planning. And so because of that, they can't answer the tax questions. And almost every topic related to what I do in financial planning involves a tax aspect. CPAs aren't trained in product. They don't know much about universal life. You kind of need that intersection of the two. But we have a full-on financial planning process, do a financial plan, and then start breaking down the opportunities, the questions. What's the short-term plan? What's the cash flow plan? My book, 7 Steps to Successful Retirement, goes through all the different steps of a successful retirement. It's not all about just how much money you have when you die. It's taxes and legacy and gifting and lifestyle and security and cash flow and growth, all these different areas. So we go through all of those with our clients to make sure that we dot all the I's and cross all the T's.
Right. Great.
I did want to mention, some people have heard of qualified opportunity zones investments, and that's where you can take your capital gains. I mean, there's lots of them all over the place. It's interesting where some of them are. Some of them are in very affluent areas, some not. So investments generally find the best areas to go. And so I know Congress passed this. I'm not sure how many businesses are being started on the north side of Alaska that I see there with the biggest red blob there. But okay, it's an opportunity zone, but it's awfully cold up there. And so opportunity zones are where, let's say you sell a business and you have a huge capital gain and you go, I don't want to pay tax on this. What can I do? Well, we're going to talk in a minute about how you can get out of that tax if part of that sale is real estate. But if it's just the business part and it's capital gains, you may have heard of the qualified opportunity zone. What that does, it does not get you out of the tax. It defers it for kind of a short period of time, just until the end of 2026. And then, but with the reinvestment, you can invest into real estate projects or other kinds of investments that are basically illiquid for at least 10 years. So you think, well, that's not awesome. And it's not for most of my clients, frankly. But it does act like a Roth account, meaning any gains that you have from your investment will be tax-free. So I call this a unicorn investment strategy. It's not something you see very often, find a use for. I just wanted to bring it up because a lot of people ask me about QOZs, and but they're not always awesome for anybody, because you got to give up control, give up liquidity. You're still going to pay the tax. And a lot of people go, well, that does not sound awesome. And I tend to agree with them.
Yeah, I mean, my experience here on this one, it's part of an overall plan, right? You probably wouldn't put all your eggs in this basket, but as part of a diversified portfolio, you may put some in there. And I do know that you know, for example, one of the projects was student housing for universities. So it, you know, produces a lot of cash flow, and you know, from a risk perspective, was relatively low risk, and you know, tick these boxes. So there are things out there that again, for a part of your portfolio to defer tax, as well as avoid tax on the gains. You know, maybe, right?
Yeah, no, that's absolutely right. You know, you might have a $10 million gain and say, well, I'll put $1 million into this. I'd like $1 million in a Roth-like account, and a good investment, like you just said. Next topics is 1031 exchange. This we do a lot of. We've done about $180 million through our office of helping people retire from being a landlord. In the case of a business sale, very often the business owns real estate, and they may want to sell the business and sell the real estate. We would want to do that in two separate transactions. The real estate transaction is eligible for Section 1031 exchange. So you can sell the property and buy a replacement property. You don't have a lot of days to find that replacement property. Once it's closed, you have 45 days. What we do with people, we don't go out and find them real estate. We do something called a Section 1031 exchange into a Delaware statutory trust. But again, with people that own real estate, investment real estate, a lot of times they've built their wealth through that. They don't want to pay the income tax when they sell it. If they do a 1031 exchange and continue to do it, they would be eligible someday for the step up in basis for their spouse or their heirs. So all of the gains from their real estate from day one, all the depreciation recapture they thought they were going to pay taxes on, goes away permanently when they pass away. So that's a big motivator for a lot of people. Another motivator is that they don't want to pay the tax now. They want to reinvest all of the money, not pay tax, and get income from all of their money, not diluted by the income tax. John, what percentage of businesses, just off the top of your head, that you've worked with have a real estate component, would you say?
Yeah, that's a good question. It's probably a quarter.
Okay.
Yeah, so you know, a lot in the manufacturing and distribution, where you know, the owner maybe through a separate LLC owns the real estate and then leases the real estate to the business. So typically we have to do two things. One is we have to evaluate if it's a market, you know, if the lease is at a market rate, and you know, we've seen it where, you know, they're overcharging the business, you know, to generate more cash flow. And sometimes, you know, we've even seen where there's zero lease payment. You know, they just, you know, they're helping the business out. We always have to adjust the adjusted EBITDA, the business, to reflect market value of the lease. You know, generally before the sale, we're getting in a long-term lease, so say a 7-year lease or a 5-year lease, the 5-year option, so that it doesn't, it just becomes part of the transaction. And so after the sale, the owner is a landlord with a long-term lease, and that creates liquidity for the real estate because it's at market, it's long-term, it can be, easily sold. And, typically they're really looking to simplify their lives at that point, and interested in selling the real estate and not being a landlord. So this would be very, very attractive, for those owners for sure.
Yeah, certainly that would be a topic, a conversation. Do you want to continue to own your own real estate? Now, sometimes the real estate, if it's something like a manufacturing facility or it's a single use type of, you are taking some risk being a landlord, because what if they stop paying? Well, how do you release that? And it's hard to find a tenant. Whereas, yeah, the easy exit we found for a lot of folks is the Delaware Statutory Trust. And essentially you sell your real estate, goes through a process that we would discuss beforehand. And then the DSTs themselves can be, you're basically pooling your money with other investors and buying into maybe multifamilies, as you see here, self-storage, student housing, big properties, newer properties that are attractive for a long-term hold. They're usually pretty cream puff kind of things. They're all leased up. We know exactly what the rents are. You get your monthly rent checks and so forth. So, I just have some types here, some pictures. Picture says 1,000 words. Like I'm senior housing. It looks like a hotel. I usually don't do hotel DSTs for my clients. I see self-storage. I see multifamily. No, I don't do office buildings. No, I don't do shopping centers. They're not very good. But there are asset classes that can be very, very good properties to consider for a Delaware Statutory Trust.
Interesting.
Yeah, so the first thing I like to do, though, when I talk to somebody about 1031s and DSTs is to basically talk them out of it. I want to find out why they shouldn't do it before we talk about why they should. So one of the reasons is you have a low gain. So somebody comes to me and says, well, I just I have this property, I want to sell it. And I said, how'd you acquire it? I inherited it 2 years ago. I said, well, you got to step up in basis. You don't have any gain. What's that? Well, go watch the slide earlier today, and so they don't have a gain. So that's a common one. I have my get rich versus stay rich. So I had one this week. He had tens of millions of real estate. He was in his 40s and he wanted to know about DSTs. And I said, I'll tell you what you need to know. What you need to know is don't do one. You're still in the get rich stage of life. DSTs are a stay rich strategy. They're for people who want to retire from being a landlord, not people that are building their real estate empire. The third one, I turned it need a life coach. I was talking to a 75-year-old guy and he was like, wow, this sounds perfect for me. The problem is, Brian, I don't have a wife. I don't have any kids. I don't have any hobbies. I don't like to travel. And I like changing toilets. If I sold my properties, what would I do? And I said, well, I advise you not do a DST. He said, well, thank you. I said, can I give you some other advice though? He said, sure. I said, you might want to hire a life coach. He laughed. He said, you're absolutely right about that. But sometimes we just don't want to sell. And that's fine too. And the fourth reason is I call it my emergency Bugatti. I need the money in a couple of years. Well, these are rather illiquid investments for a period of time. So if none of these four apply, then we can have the discussion about why you may want to do a 1031 exchange with a Delaware Statutory Trust.
That's very, very good. Very good analysis, Brian. Appreciate that.
Thank you. So let's talk about why someone might do one. Diversification. So you mean I can sell here's a story I had. A client had an apartment building and it was in Seattle and he was just kind of done with it and being a landlord. And so we did the DST, put him into, we had two of them. He ended up with, I think, over 10 different investments. They're across all those asset classes I showed you earlier in different states, across the Southeast and Texas and Florida and Arizona and Colorado and all over the place. So he had a really great diversified portfolio. Less than a year after he sold his apartments, which were right next to this precinct in Seattle, I think they called it the Chop District. Yeah, that all happened right at his apartment, and he was just so thrilled he had gotten out and diversified his portfolio. Obviously, he was able to sell his apartment. It had gone way up in value. He had virtually no basis in them anymore and has not paid any income tax. And we're going to keep doing the 1031 exchanges, and there'll be a step up in basis someday. In this case, his cash flow doubled. It doesn't always do that. Sometimes it goes up, sometimes it goes down. I've had people come to me and say, well, if I sell my rental houses, I might get a little bit less in monthly rents doing those DSTs. I said, yeah, that generally happens. If somebody retires from their job and you have a job being a landlord, they generally make less money than they do when they're working. Oh yeah, that's right. I'm working, aren't I? I said, yes, you are. So you might maybe making a little bit more money. Very often though, most of the time, in fact, when I look at a tax return and Schedule E and I see their rental schedule, they're surprised to find out that after repairs and all the expenses, when you divide your actual income into the fair market value, they actually get a pay raise by retiring from being a landlord and doing the DSTs. So a lot of times they're just shocked by that because they didn't really put two and two together on the deferred maintenance aspect. A lot of times we're talking about buildings that have a lot of deferred maintenance, and they say, well, I'm making 6% a year right now, so I have really good rents. Of course, every 3 years it goes, everything I earned for the last 3 years goes back into the building for a new something, roof or elevator or HVAC system or something, and they don't always consider that, and that wouldn't happen with a DST. All of us are getting older, and people that have jobs get to retire from them. Landlords don't often feel like they get to retire because they don't want to pay the tax. We retire from our job, there isn't some big tax bill lingering during our retirement, but a landlord there is. And so this is a great strategy for those folks that want a lifestyle change for sure.
Right.
Finally,
hey, Brian, could I ask go ahead.
Sure.
Finish.
No, go ahead, interject. Yeah.
Well, no, I was going to ask you to just move on to slide 21.
Yeah.
And I know this one's a few slides forward, but I think, I mean, this is really the crux of the issue with business owners. And I'd like you to just take a couple minutes and walk through everything in the roots there, because I think the qualified opportunity zones and the trusts are great tools, but really only in the context of an overall plan. And so I just wanted to give you just a minute or two to talk about what does an overall plan look like.
Okay. Yeah. Thank you. Yeah. That I added the financial planning aspect to the firm. Like I said, 25 years ago. Not because I thought the world needed another stockbroker or insurance salesperson or whatever, but my clients told me they needed somebody to integrate all this stuff. So as we look at the roots here on the far left, growth planning, you might think of that as a stockbroker. So if that's all you're doing, that's fine, but that's one route. That's not really a plan. A stock portfolio isn't a plan. That's a thing. That's an investment. Protection planning, that might be the life insurance and safe money. That could be an annuity salesperson. They say, hey, I'm going to protect your assets. We'll put you in annuities. Okay, but that's not a plan. Buying an annuity is not a plan. Healthcare planning, that might be long-term care, Medicare supplement discussions, all that kind of thing. Legacy planning, that's estate planning. There's a lot to that, and most people in my industry are pretty uncomfortable talking about that because that's not their product sales. Lifestyle planning is probably the most important route in all of this. None of it matters if you're not living the life you want to live. So you want to integrate all this stuff. And then on the blue side here, we have the gift planning, what you do with your money while you're alive, and then of course succession when you pass, or we could actually succession would be more of the legacy planning. Succession planning relates to our topic of this series, your business, your real estate, whatever it is, whatever your money is. Real estate planning is the next one. A lot of my clients that have wealth have real estate. And finally, income tax planning. I feel like all of these need to integrate to do a good job.
That's right.
I mean, I don't think I'm going to get a lot of pushback on that statement, probably, John.
Yeah, and it's, I mean, my experience is most business owners have not taken the time to really think through all the roots here and to have a comprehensive plan. And once they go through that process, and that combined with, okay, and John, you're telling me that my business is worth between 20 and 25 million, and that I could walk away with, 18 to 20 million cash. And Brian, you're telling me that that's going to generate, $2 million of cash flow a year for the rest of my life and continue to grow in value, and then I could pass that on to my heirs, tax-free in a tax-efficient way, and do all these other things and have a plan. I would just really encourage, any business owner, you put yourself in a position where you have this wealth, but we live in a complex world, and you have to lean on wealth management experts and accounting experts to avoid mistakes, frankly speaking, and avoid paying tax. And I mean, I would say most business owners have not taken the time to create this personal financial plan prior to the sale. And I think that's really the theme here is, hey, we want to maximize value on the sale, and we want to minimize taxes. And that's what we hope that we could achieve for all of our clients.
Couldn't have said it better. So thank you, John. Just to kind of follow up on the last couple slides here, I mentioned QOZs and 1031s. They're different. We can have the discussion. That's a nice thing about this stuff. We have the discussion. I'm not going to say, oh, you need to buy it because I can sell it. It's I'm going to start with why wouldn't it fit first, certainly, and then we'll certainly integrate the estate tax planning with the step up questions and all of that. I think we kind of come to the end of the topics. I just kind of wanted a little taste test of different topics here today related to, you don't have to be on your own, because one of the things that a lot of my people that I talk to are concerned about is, okay, I knew what I was doing when I rolled out of bed when I was working. I was getting on that hamster wheel. I was running hard, and now I'm going to have to plan for a life where I don't work anymore. I don't get a paycheck. I don't have that purpose. I don't know what exactly that looks like, and so we want to be there for that part of the process too. So that's what today was about. But John, I want to turn it back to you and talk about the first three installments of this again, just kind of a recap on that.
Yeah, and I would just throw out if anybody has any questions or even future topics that they'd like to see a webinar on. Now would be a great time to throw those in the Q&A box. On our side, we have two types of clients. One client who, they get an offer on hand, or they wake up one morning and say, hey, today's the day. I really have decided to sell my business. I think it's ready and I want to go. The other client is, hey, I own a business. I think I want to sell in the next 1 to 5 years. What should I be doing now to get ready for that sale? And we welcome both of those clients. Obviously, a preference for the clients that want to plan for the sale, because then we have more opportunity to grow value, and then you would have more opportunity to put tax strategies in place to minimize taxes. But if people are super busy and sometimes life happens, and situation is, hey, we've decided that now is the time to sell, and we can move fast and make things happen if we need to, but having a plan and starting a few years in advance is always better.
Totally agree with that. And so coming to the end here of the slides, I'm supposed to put the disclosures up here. John, I've thoroughly enjoyed this, doing this 4-part series with you. I think there's a lot of good stuff in there. If you're listening and you missed any of the others, again, just go to the website or just send us an email, and we'll be able to get that out to you, the links for that. I want to do it again. We'll definitely chat about how we put that together. But hopefully that everybody that's listening or listened in on this got something out of it, got a nugget out. As I tell people when I speak, don't expect you to remember everything and or get something out of every minute. But if you got 1 or 2 good nuggets out of that, then it's worth your time. So hopefully you got that.
All right. Thanks again, Brian. Really appreciate it.
Yeah. Thank you, John. All right. That's a wrap, folks. Thank you.
All right. Thank you.